This is Justin Pulitzer. This is my weekend review video for Sunday, July 24th, 2016, although it is being recorded on Saturday the 23rd. The early release. Been getting a lot of requests for that, so I figured I might as well do it once in a while. Anyhow, let's jump in. Good amount to discuss. I'm going to cover a lot of new material this week, including some stocks I talk about on the stream, but that don't usually make it into the weekend review video. But let's start out with some macro stuff and also the market indicators. We had a couple of macro numbers this week that interested me. The first and foremost was the jobless claims. The last reading was 254,000. These are the continuing claims, and then the expected number was 265. So they were expecting more, and it just went down 1,000 to 253. So that number to me is really just a push. I think that they kind of I don't want to get into too many conspiracy theories here, but I think that they manipulate these numbers to make them look a little better than they are. So I think they set the bar really low. The one that was more important to me, though, was the Philly Fed number. That's the manufacturing study. The prior reading was 4.7, and they had expected it to be 5. And the actual number was negative 2.9. That is a gigantic miss and a really piggish number, and has me thinking the lower for longer thesis should be intact. Philly Fed's an important one, and that was absolutely astounding. I think that really just, I want to say underscores, that's a good word for this, underscores my view that the jobs that are being created in this country are part-time and temporary. I've talked about the waiters, waitresses, bartenders, carnival ride operators, you name it. Not high-quality or high-paying jobs that people can really base careers on. And that is obviously evident in the lack of wage inflation. So, you know, when we get, I guess, quote-unquote, beat jobs numbers, you know, the knee-jerk reaction in a normalized market, which we all know we're not in, is for the market to sell off because there's fear of inflationary pressures in terms of wage growth and for the Fed to raise interest rates. Now, we need jobless claim beats just to keep us out of recession. It's a very, very different time. You know, I've heard, I'm going to talk a little bit about that when we get to the TLT and the PE multiple premium. I've been hearing some more people coming to that realization. We'll discuss when we get there. Anyway, let's talk about VIX here. I'm getting a lot of people asking me, is it time to short the market and is it time to load up on puts because the VIX is very low? All right, so my answer to that is this. Yes, the market's very low. The VIX is beyond bombed out here. But it may not necessarily come roaring back. You can see we've been through periods of time here with fairly benign volatility. It usually does lead to periods of more pronounced volatility, but those periods can last a while. You can see we could just be bouncing around in range. We undercut these lows here. This was 1250. I had talked about 1280 being a key number, and I think the high of this bounce here was 1306, and then, you know, we couldn't get back above it, and then we were back below on Friday. So I wouldn't be surprised to see a little bit of this. I wouldn't be shorting premium here. You can see I have my VIX key. We are in purely directional options play here. Either you're buying or selling puts or calls. You may even want to, I mean, you could do spreads, but when, you know, premium's this cheap, you definitely don't, I shouldn't say definitely, but you really don't want to be a seller of premium here. You want to be more of a buyer for directional play. So I'm thinking we probably do get some kind of a bounce in the VIX, but it could just be of the more benign nature, at least for a little while. I've said for a while that one of the biggest issues that the market has is that the S&P 500, many companies are international and global, and they do business overseas, and they have to repatriate their currency. And there are risks with that, meaning that if the dollar rises, those earnings become less. And we are in a period now of a dollar which is rising. we're back to kind of the middle of the range. I use the UUP here just because I think it's a little easier than the DX. You can see we're into some key levels. There's also a big volume distribution. See where this kind of curve here trails off. So the dollar, I mean, it really literally just broke out, though. I mean, the 200 MA, we pulled back, it consolidated under there, and then was kind of a gap and go over. So the dollar seems to be rallying, and that could be some headwinds for the market in coming weeks. We did kind of come up from the bottom, so it wouldn't surprise me. I mean, if we do get to range high, it'll probably be a short, but this might kind of cool off a little bit. We'll see. The pattern to me looks bullish. I mean, you can see we're in a bit of a channel, and we're kind of poking our head above the channel, and it's been smacked down before. So I wouldn't necessarily be chasing the dollar here, but this is a problem. If this does really keep going, stocks won't be able to ignore it indefinitely. So coming into some resistance, this was past support. This should be some resistance now. It was a range level, a volume distribution. So let's keep an eye on this. This is very important. If this really just does start soaring, you probably do want to start trimming some positions a bit. As the gold is priced in dollars. Gold is still, believe it or not, in a downturn. Let me go a little longer. 5-year weekly. You can see there's a long, pronounced down channel. We didn't quite get to the channel high yet. My thinking here is the following. Get into a 9-month daily. I measured some pullbacks from peaks to troughs. Hope I'm getting my pronunciation better on that. Yeah, so we're kind of holding a uptrend within an up channel in a larger down pattern. Yeah, I know it's a little confusing. I'll keep it simple though. We have a big emotion day here. This bar. Let me just draw in this trend line. Alright, so take a look at this. Ideally, if I had my druthers, I would love to see this really pull back further, get a primary trend channel touch that coordinated with the 61.8. It's also a major volume distribution in the 121s. Cloud a gap fill slightly lower, 120.11. So between 120.11 and 121.29. Ideal setup to buy the dip. You also have a 50% correction level, which coincides with a 50 MA around the 123s. So I think in this range is probably going to have some support. You had a bit of a reversal bar here. You have some lower highs though and some lower lows, so we're in caution mode. I'll keep it simple. Anything above 127.37, which is the high a day here, I think we could move back to the highs. Anything below those lows, and considering it a pullback day, I think that we could come down and retest. A good way to play this is if we do get the move down. Obviously, if there's a break up, you could just buy it or buy calls or call spreads or whatever. If there's a breakdown, you could obviously just short it or play put ratios where you buy one of these puts and sell like 2 times out of the money down here. Very near dated. Or just sell some naked puts if you don't mind owning it. So that's my view on gold. If the dollar does keep rallying, gold should struggle. So before I talked about a PE multiple premium. I've talked about this in past videos seemingly ad infinitum, although it is now starting to become, I guess, more accepted as a principle. The theory here is that stocks are priced on a discounted cash flow model. I don't want to get into the specifics of that, but I often use the just simple division example. You have a numerator and a denominator, and if you have a higher denominator, you have a lower end product, and if you have a lower denominator, you have a higher end product. You could think of interest rates in that regard. So strong bonds, or relatively strong bonds, higher stock price PE multiples. I heard some people on TV, not today, but during the week, saying that the market is trading at 19 or 20 times earning, close to there. It's probably about accurate. The and of course that's unsustainable. These are, of course, the same people who always say 15 is the correct market multiple. It's actually not correct. Usually 20 is the upper end of the multiple and 10 is the lower end. Moves above at 20 or above are unsustainable to the upside, and moves below 10 are unsustainable to the downside. That's usually when markets peak and when they trough. So let's keep it simple here. In the past, in 1929, 1987, I believe, I think 87 was the exception because of the interest rate policy at the time. So let's X out 1987 for the moment. But 1929, 2000, and 2007, market kind of topped at a higher PE. But the big caveat was there were 6% interest rates. Here, we're maybe just futzing around 1.5%, 1.6%. We've been vacillating between like 1.4 and change and 1.6 and change, with, of course, the higher PE multiple. My thesis on this is that the Fed has told us in the future that they knew they used to normalize at 6% is now going to be 3.5%. That was actually my target rate before they even announced it. And I'm very glad to hear that they have come to the reality that the world is different, and I believe that that is the appropriate number. However, we don't have inflation in the sense that the Fed needs to move. I gave you that Philly Fed number. I told you about the lack of pressure in terms of wage growth and jobless claims. When people talk about inflation, it's really more of the screwflation type, where you have higher medical costs, higher food costs, higher energy costs, factors that don't get factored into the Fed model in a traditional sense, although we know that they are starting to look at them. I believe all of the old way of thinking in terms of economics, we are outside of the norm, and I don't really know if it will ever return to it. Ever is a really long time, so I never like to be that definite about things, but I will say it will probably not return to that for quite some time. And the Fed's accommodation policy is, I think, prudent because of the issues that we're having in the labor market. I've talked about the rise of artificial intelligence and automation, and the quote from Terminator from Sarah Connor, "A storm is coming," is quite accurate. I think that the military in the past has been a place where people go to serve, they get college education, and I think a lot of the military is going to be taken over by drones. It's already starting. That's where the biggest budgets are. Planes will be flown. They already are. But I think that AI and artificial intelligence is going to be really taking over the Air Force and potentially the Navy and God knows what else. I saw a study where they put some of the world's best combat pilots up against artificial intelligence flown aircraft, and it was an absolute slaughter. The AI beat them every single time without exception. In the past, that has not, it's been clunky and hasn't worked, and some of the newer programming, because of some of the new, I guess, hardware and some of the new software, is really getting to be quite impressive. So that change is happening, and those jobs that people manned in the past, they're likely never coming back. That's going to be a depressor on wages and the economy for a while, and the Fed is correct to stay pat. Sorry to have gone off a little bit into a lot of detail here. I know that it can be hard to listen to sometimes, but it's reality, and it's really important to keep an eye on that. Anyway, I've done some measured moves in the past. If we took this exact measure move and projected it here, it's roughly near the 50% fib and the 50% fib and the 50 period moving average, 50-day moving average. I think between there and the 61.8, if there were a move up in rates, would find some support, just because you have these old past highs here. You have a fib level. It just seems to me like that will be an appropriate area. It's also possible that this just, it kind of filled in here and can gravitate. I've said for a while for stock prices, this just doesn't this doesn't necessarily need to go higher. It can just go sideways. The only issue will be, and you'd have to start discounting that PE multiple premium, is if you get something like this, where rates are starting to rise and it's in a more pronounced fashion. It's easy. It's strange to me to see, I guess, people who are just idealistic and just can't see anything positive. They just, as far as the market goes, they always say that interest rate spikes are bearish, and then the same people say that the sell-offs are also bearish. The run-ups, of course, mean recession, and then the pullbacks mean that the Fed is going to have to, that maybe things are getting better and they'll have to raise rates, or, the bond bubble is pricked. I mean, yeah, this is a pretty big bubble with regard to the bonds, and this is going to, of course, end poorly. It's just more of a matter of time. But this could last quite long and go longer than people realize. I've given the musical chairs analogy, but if you leave the record on repeat, it can go for some time. So yeah, rates could rise a bit, but given the place, I mean, look where these peaks are. Even if you pull back, even if this really came down to the channel low, I mean, you're still above the 2009 crash top, which was 123. Let me show on a longer term chart. 10 years weekly. Well, this was the end of the world, right? I mean, we're well above there, and even if this came back down, I mean, it would still be historically very, very low interest rates. So, like I said, all you need is rates to kind of hang out and just not rise too quickly, and things will be okay for PE multiple expansion. HYG. So when recessions or calamities take place, it always starts in the credit markets, where lending on, I guess, lower quality assets has a problem. The premium goes up over the risk-free rate. And you can see this period here got the Fed very nervous, and this is really when Yellen capitulated and said that they were going to go back and stick to lower for longer, and she's sorry she kind of raised rates and they won't do it again. You can see this is just consolidating. It's actually broken the long-term kind of downtrend, and credit is actually improving. You're forming a bit of a shelf here, and it looks like it could rally. People are having more of a risk appetite. That isn't screaming to me a recession. I mean, if you get one of these and you start pulling back, then I think it's time to kind of tighten up a little bit. So we could use this range here. It's a very narrow range as a guide if you're an HYG player. 85.51 and 86.32. Yeah, I mean, this could, like I said, this can pull back a bit, but as long as you're not in one of these, I'm just not thinking recession here or any kind of financial crisis. That's really what you need for the, the end of the world type of scenario. It'll happen at some point, but I'm not seeing that in the chart here. It just seems like a steady progression higher. Oil. So it's fitting that we talk about oil when we talk about high yield, because a lot of the fear on this decline here was caused by cratering prices in oil and overextended energy companies that had levered up their balance sheets and needed higher prices in oil just to break even. I gave the mouse and the bell example, where you put a bell over a mouse, and obviously there's a limited amount of oxygen in there, and the faster and more they breathe, the quicker they deplete their oxygen, and they die. The oil companies here were struggling to pay debt, and they were pumping faster and faster at lower and lower prices, further depressing the prices just to meet debt payments, but only perpetuating the cycle because they were pumping more and more, producing more and more gas, depressing the price when they needed prices to rise. You did get a rise in oil prices. I don't know what happened here, but we just want CL. you basically doubled off the bottom. I talked about this getting up to 49 to 52. That's roughly where it topped. And we are pulling back. I believe that, first of all, we know from the Baker Hughes rig counts that week after week now more supply is coming on, and I believe that's what depressed prices. But I believe a lot of the struggling companies, and there were a few bankruptcies like the Lin Energies and so on and so forth, a lot of them, by and large, were able to hedge in forwards and futures markets and probably took a lot of that kind of keep the lights on risk off the table. This has been a rather kind of controlled, gentle pullback, and we're first coming into some really key support levels. Anything below 45, I think, has 42s and maybe 41s, the 200-day moving average in play. You can see it with some resistance here, a little bit of resistance again here. We got through it, and a retest makes a lot of sense to me. We're a bit of a long way from Kansas Toto. I give that example when you've run a lot and you have Fibonacci levels. It's conceivable we pull back to the 38s and maybe even 35s, and if that does happen, the market isn't going to like it. But it seems to me we've used up a lot of time in the stochastics here, and we've corrected a little, maybe. I mean, yeah, there's been a pretty decent price decrease, but it's been, it hasn't been just a one-way directional trade. There's been some back and forth, and it seems to me that this area should quote-unquote, hold. Yeah, I mean, if things get a little dicey, I think the 50 could be in play, but I'm looking more to buy the dip here than I am to get panicked. Why? XLE isn't really showing tons of weakness. This is also just consolidating a little bit more by time than by price. I would love a 200-day moving average touch. That's the same kind of story that we had in the past, but the 50 has been holding, so until the 50 breaks, I'm not going to get too cray-cray. The 100 is also coming up rapidly. So if we get a breakdown into this area, and it's always entertaining when things like that happen, 100 to 200, assuming there's a move, I would be a out-of-the-money put seller probably at some of these fib levels. That's what I'm thinking, but this just to me looks like more like consolidation at the moment than it does panic. Same thing in Exxon, which is the leader. The issue I have, and I've said as we rallied into Exxon, we've had now multiple days of underperformance. But look, it's been a very begrudging pullback. We're at the channel high, okay? That's just it. I mean, this basically rallied from 71.5 to 95 and 95.53. Yeah, this is it's due for a little bit of pullback. God willing, we get a pullback into some of these reference levels mid-channel. Maybe we got to the edge of the upper volume distribution. Now we get to the lower end, maybe 87-ish into some of these reference areas. 50 MA, any moves below it have been unsustainable. I would love to play put ratios for a move down to the 50 MA. Yeah, I've been kind of short puts as my long proxy up in these higher levels, and they've been coming off just because they've expired. You can see I drew in an informal kind of regression line. It has been support here a couple of times, and now it's resisting a bit. So I think Exxon can pull back. A longer term, I think this thing wants a hundo or close to it, but maybe it just pulls back a little and then starts up again. But I think Exxon is getting some needed consolidation, and it isn't showing really that oil is in full collapse mode. FXI. China. This is also important. You don't want to be in one of these crash modes that is troubling to markets. 200 MA was the break. We never took a long time to get back over it. We seem to be in an up channel now. The old downtrend, the old uptrend is coming up. So my thinking is that FXI could probably continue to the channel high. Maybe get a retest up here into this region, where the big supply is, the next distribution up in the 37s. We'll see. I like that the moving averages are all kind of bending up. The 200 is flattening out. The 150, though, are on the rise. So I think that given the fact that we're making some higher lows and higher highs, you could probably cautiously play some dips if we do get anything near those moving averages. Another major gauge for risk on, risk off is this IBB. And this had a bit of a look below and fail. And I think you just got a lot of late to the party chaser short here and some flush. You can see that the volume coming down was drying up a bit. And they forgot that we had come down from the top. It had already moved a lot. And now it's just getting back up into this area. You have a 200-day moving average. Look when the breakdown took place. There should be some resistance up here, given the fact that, we now came up from the bottom. So any breakout here, which I think will get a lot of people excited, could be a little bit suspicious given that we're coming into these reference areas and the 200, and we'd basically just be filling up the triangle. I would be more interested if this were to like come up, pull back a bit, and then go. That's my my thinking with this. I mean, listen, if the market gets excited, it could easily just, go. But we now have rallied a lot, so if you caught it, I'd be looking to book some profits on pops and then looking to maybe reload a bit on the dips. I was hoping that we were going to get a final flush down here. We still may, but this is starting to just look like it's going to chop for a while in this sort of flag pattern. So let's get to the major market indices. SPY, we are above the box. We got the 1.272 fib extension. We have a 1.618 fib extension that's up near a channel high. We've consolidated here for about a week or so based on price, based on time, not as much price. So there's two ways that this can go. This can either break up and get it, or we can pull back and then maybe rally and get it. My thinking here is that market just got a lot overbought. We came up again. Remember when I said come up from the bottom? Look at this. We got the. I drew in a new. This is. I guess it's not so new. I drew this in for last week, but we've come up. I mean, a lot. This is good that it's consolidating a little here. Here this day, Wednesday we had a bit of a look above and fail. Then Thursday they tried to sell it off, but the sell-off was kind of wimpy. It was just very weak breath. I shouldn't say weak, meaning that the breadth was weak, but the sell-off was weak. This was just like 2-to-1 negative. I mean, for really negative days, you need like 5, 6, 8-to-1 negative. And then the next day we bounced back and basically just holding the 10-day moving average. So short term, can use this range as a guide. If we break the range, these were poor highs, by the way, so if we break those highs, I think we would repair them. If we lose the range low, we could get some kind of and the 10-day moving average here, we could get some kind of a pullback to retest the breakout points, which was 213.78, 212.52, and I think could even get as much as down to 211. Remember the Brexit high here was right before the Brexit sell-off was 210.87. That would be a very large liquidation break and sell-off, and I think would get a lot of people freaked out, but it really would be quite a normal pullback. With VIX this low, I mean, if you want to play, if you're long and you want to have some protection, or if you're bearish and you want to play directionally, put spreads are pretty cheap. I don't like the weeklies. I've talked about that. I discussed that in the the Periscope this week. How I like to sell near dated premium to buy longer dated premium. So VIX is real low. These would be real cheap to play if you're interested in doing so. But my thinking is that this really should resolve a little higher, just given the fact that we've spent 1, 2, 3, 4, 5, 6 a week, more than a week, 7 days of trading, like almost a week and a half, just consolidating here. I would think that there would be some type of a move higher. Again, I don't discount the move lower first, but it seems to me like the market does want to get a little bit, get that full extension. I drew that extension, by the way, just off using this high and this low. You take this number, you subtract this number, get your end product, multiply it by one of the fib extensions, and then just add it to the low here, and that's a fib extension. Very, very simple mathematics. The expected move this week in SPY is $2.47. I think it would be more on the downside given where we are in the IV. That would roughly be 214.77. 215 we know is an important strike. So my guess is a move down would get a retest here of the breakout. A move up, that would be 219.71, but it could overshoot. I think we'd get the 1.618 fib extension, and then we would be really overbought short term given the fact that we came in basically a straight line from the channel low to the channel high, and I would be looking for some shorting opportunities up there. I think that things would get really, really stretched at that point. IWM is looking the same with a lot of consolidation. Look at these old reference supports. It's just been chopping. There's room to the channel high here. We broke the downtrend. We're in now a bit of more of an uptrend. We've just been consolidating over the breakout. So this could be a little bit more dramatic. If this were to fail here, I think that we would see a move back probably to the 115s, maybe even the channel low if this got really, going. But again, we could just move to the channel high. I'm going to use the range again as my guide. Anything above this 120.58, these highs were 120.60-ish. So anything above there I think is still, a long. Anything back below here after spending this many days consolidating, I think we'd get a bit more of a severe liquidation break into some reference levels. So I think the break of the range is probably the a right or right out go with. The Qs. So Apple is going to be reported. We have a lot of big tech earnings this week, so we should get some I think this week is going to be the week of resolution. We have Apple on Tuesday, Facebook on Wednesday, and both Amazon and Google on Thursday. So yeah, there's we're going to know soon with regard to this. We're coming into some resistance area. Again, higher lows, now making some higher highs on the leg. I think that there'll likely be some resistance at these past highs, just given the fact that we've come up so much. I mean, the most bullish thing would be is if this thing just got up here and then just kind of consolidated sideways again. But we're getting a lot of move. The breakout here was 111.44. If there is a miss in some of these, or if let's say there's a sell the news in some of these big names, I think we could get a retest of sort of this breakout point here in the 110s, maybe even a 50 or 200-day test. That would be quite dramatic. I'm looking at some of the expected moves on some of these stocks, and let's take Apple for example. The expected move here is only into the expiration on this week is only $4.06. It seems to me like Apple is going to move more than that. Just my hunch. Here we go. We had basically a double top in this area, the hundreds. It couldn't get through. We got close to the downtrend. It's a little bit telling that we couldn't, and it's pulling back. The ideal situation for Apple would be kind of down big Monday and down big Tuesday, kind of set up that shake and bake, get all these kind of late chasers in. My ideal setup for Apple would be a dump on earnings, because we know the iPhone 7 is coming out in the fall, and I think that the stock will rally for that. So I'm kind of hoping for a clear the decks washout. Maybe we finally get a trend touch and a 61.8 touch down, in the 85 area. If I'll tell you this though, if we break the downtrend, 103 will be a big level, and that's also the 200-day moving average. But if we were to break the down channel, then I think you can start playing buy the dips again in Apple. This might be a if they rally it ahead of the number, it could be a right or right out short for earnings. The IV will be so low if they do rally it that I think that the directional play would be a cheap. So even if it's wrong, it doesn't really matter. You're not going to lose very much. I ideally, though, would like to see this come down and get the IV up and be able to maybe sell some out of the money premium. But as of now, this is just pure directional speculation. I like to be the second mouse, either buying it down on a breakdown at opportunistically, or on a long protracted down channel move. A breakout to the upside, I think, could be quite dramatic for the coming for the fall. So waiting for either the trend touch or the breakout. If I decide to play Apple, and I likely may for earnings, I'll post whatever it is that I do. Amazon, they have earnings on Thursday. Like I said, the expected move into expiration is $52.98. What I will likely do in Amazon is sell some massively out-of-the-money premium late in the week, because they report Thursday, and then you'll just have Friday. So you'll have one DTE with super-duper jacked premium. I'll likely sell 2 times out of the money. Like, I'm thinking like $100, maybe puts down here, because I think that there would be some muscle memory. I've talked about the 1.618 fib extension, which is up near a channel high, 833.91. I don't know if that's going to happen, but it just seems to me like this could be poised for a move like that. If they rally it hard ahead of the print, it's probably a good idea to take some profits. If it just stays sideways, or if this really dumps hard ahead of the number, then I'll be thinking maybe it is a long. These highs are, not really all that impressive. They don't really look very blow-off-ish. Amazon has topped like that before, where it kind of just has like this little incy look above and fail, and then it kind of comes back down. Maybe that's the same thing, but it seems like everyone is so bullish on Amazon at this point. 50 MA held, channel is held. I'll think it. I'm gonna, until the channel breaks and we lose this swing low here of 728.72. I'm still thinking that this probably has a little bit more to go. Facebook is reporting as well. This had a bit of a look above and fail. Just look why. You came up from the range low. I talked about this being the same. It's the same pattern every time, right? It consolidates. It has a freak out to trend. Again, to trend. This was a gap fill. This is no different, and it rallied. And I think it had just rallied so far so much from the kind of the consolidation lows here. The old highs here and then the lows here, that it was just some profit taking at some reference levels. I'll kind of be thinking that if they rally this hard into the print, and their print is on Wednesday, the expected move is $7.44. If they rally this hard into the print, it could be a sell the news event. I do think longer term we're going to see 128.55 and 130.43. If they sell this off hard ahead of the number, then I'll be looking to be a buyer. So either booking profits on a rally or looking to buy the dip if it gets hit ahead of the print. It might be a little bit of one of those Costanza plays. Netflix reported they were not good. I've talked about this not being the best seasonal quarter for them. It tried to rally. We're now back down here. You have 1, 2, 3, 4 days of consolidation. If you lose these lows, I think we'll quickly see the 80s and maybe finally see the old breakout here at 69.99. I would be an interested out-of-the-money put seller if we were to get down there. This could try to fill the gap if you do get above these 4-day highs. I think that the trade would be a quick long for a move to 92.93 and maybe even a gap fill. But if we do lose these lows, then it's a short. So I'm looking to either be long on a break of the consolidation higher for a partial gap fill, or a short below these lows for a continued dump. Notice the consistency here. I want to be either long over ranges or short over ranges. So Google has their number coming up. You had a bit of a look below and fail here at reference lows. Ideally, the situation Google this quarter I don't remember being strong either. Similar like of a Netflix thing. The Google number is coming out on Thursday. The expected move into expiration is only 37.46. Again, that's really strikes me as low. So this is pure directional play. If you think that this is going to break out and going to get a move to the highs, I would suggest call spreads. If you think it's going to come down, I like put spreads. If they rally it again into the gap fill ahead of the print, I'll try write or write out. I guess it won't really be write or write out. I'll try put spreads. Like if they were to fill the gap ahead of the number, again, coming up from range low all the way up to range high, it just to me would favor a sell-off. Google sometimes acts funny on their number. Like you'll get a move and then it'll really move more regular RTH. So I think there'll be a lot of continuation to play in either direction in Google. I like the idea that they're reporting Thursday. Friday morning, I'll be very interested in selling same-day expiration out of the money premium, maybe both on both sides, either calls or puts. So that's my story. Particularly if it's a gap up, I don't know if it would necessarily come down as quickly same day. So I'd probably be interested in selling some out of the money puts. We'll see. I do think that this gap is going to fill at some point. Maybe even here. Ideally, like I said, I'd love to see it fill ahead of the print and get just really overbought, squeeze out all the shorts, and then kind of set up for a move from range high maybe down to range low. The outside scenario is, of course, a move to the channel high, 862. I don't think it will do that on a gap. It could, but if we do get a move up here and it's not coming down and you break these moves there, like I said, there's going to be room for continuation given the fact that the options are only pricing in a small move. I think that this one could easily be outsized. We'll see. It may not be, but that's just what I'm thinking. Again, more of a second mouse unless we get the move ahead of the time. Tesla. So the master plan was released. I thought it was pretty good. It didn't really do very much for the stock. You actually got some sell the news. Again, I think this is just because you rallied up. You do have a downtrend break, and my thesis on the long is that they're going to squeeze it into the numbers. I still have a long or dated, I think it's like the monthly call spread, the 230, 260, and I'm short weekly 205s for next week. Just on the theory that this, listen, if you lose you have a lot of moving average confluence here, 50, the 200, the 50, and the 20 MA. I think that this area will support and that there should be a move higher. If this breaks, I'll just take the profits off. I did say, by the way, this day ahead of the Musk thing, it was a good idea to book some of that. That turned out to be quite prescient, but this to me is just I wouldn't say it's a failed breakout because this bar here is still, the context here is we're still within that range. If you lose this bar low here, the 218.30, and I would be willing to give it a couple of points to these major moving average confluences because I think a lot of people will be. You could see the 200 was a lot of resistance here. It broke out. It's just been kind of consolidating now above it. The 200 is really important to me. So anything above the 200, I still like the stock long. Below it, is a GTFO and maybe even a write or write out short. Keep it real simple with Tesla. Chipotle has been a hated stock, and at long last, this may have bottomed. The earnings report was god-awful. Their comparable store sales were down 23%. Very, very, very piggish quarter. There was a huge range in the after hours, and the stock, I said that if this couldn't go down any longer on that piggish number, that at long last the sellers are likely exhausted and it's heavily shorted. You have a down channel break, a break of the 50-day moving average, and it moved up. You're into some past resistance and some fibs, but I think as long as you can hold maybe half of this bar, if there was a pullback Monday, I would be interested in maybe a write or write out buy, kind of near these lows before the breakdown. It shouldn't really lose those again. For some continuation higher, I don't think that this squeeze is done. We'll see, but this to me is a bit of a pattern changer. This was a big consolidation range. It seems to have broken out. It stalled right at the 100. So a couple of days of consolidation up near the highs of this bar to me would be a safer bet than just playing. My guess is you're probably going to get some kind of a move up higher early, like Monday, and then like Tuesday and the rest of the week there'll be some consolidation a little bit lower, and then it'll probably run again. That's just my theory on how this is going to trade based on maybe some past ways it's traded. Another one that got nailed big time is the Skechers. Look at this. We're back down to these lows. It was, I wouldn't say a look below and fail, but we're kind of just here. If you lose these lows again, I think we're going to come back down and fill in some gaps here to the 23s and 21s, where I would be an interested buyer, given that that's where this big base started from before the run. I think that this area would be buyable. If you want to play right or right out long here, you're right near the bottom. 24.16, anything below that, you want to not be long. Anything above there, I guess you could be long. The worst scenario for me would this be, at least if you're long, is if this just spent a couple of days going sideways and then broke. That would be a short. That would actually be an amazing short for a play down here where it can't recover. It has like these minor bounces, and then you lose this low of day after multiple days of consolidation, and you get the last final flush. So that's the way I'm playing it. This bar is too big, in my view, to wait for a move over the high for the gap fill. Although you can. That's one way of playing things. I usually use these earnings bars as a range. Above the high, I like long, and then below the low, I like short. I still like that. Just given the size here, I'd probably do it smaller because look where you're into. So yeah, I ideally would like to buy Skechers down here. Their product, it really isn't so fantastic. You know, I've been into their stores. I've been into the one in Union Square, and their shoes are cheap. They're like in the $60 range, and they always look nice and they're appealing, but they never fit. I've never been able to get a pair of Skechers no matter how many times I try. On the other hand, I was up at 10 o'clock this morning to buy a pair of retro Air Jordan 5s, which were, with tax, $239. And I was like, with bated breath, I got up early and waited to buy those, and so on and so forth. These, there's no super duper excitement. The stock is obviously not as expensive anymore. I think their management is pretty good. I think they will get it together. I would be looking to, like I said, buy it down here if I could. So I either want to play for a quick short down here, a smaller size long up here, or wait for it to come down here. Those are the couple of ways I'd be looking to play some Skechers. Nintendo. I really should have talked about this in last weekend's video review, but it was just still in a crazy mode. I didn't really think there was that much to do other than to still be a little bit long. We're coming back down into some levels, depending where you draw. Look where we had this old kind of move. It was in 24s, 25s. If you draw a fib retracement from this low or from this low, you get different 61/8s between 24.98 and 24.09. That coincides well with these highs. I will be a buyer for a right or right out play there. There are no options in this. It's an ADR, and it trades in gaps and is weird. I would play it a little bit more, I guess, small. I don't think that this is going to fill in completely, although I probably would buy a little here, and I know I never like to add to losing trades, but considering I'm doing it small here and it's part of the plan from the beginning, I'd buy a little here and then probably buy a little down here, like 19 or 20-ish, if it does fill it in. I don't think that this move is done. I think that this Pokemon thing is real. I think that Nintendo is trying to turn the page. I know they have a new console coming out soonish called the NX. It's supposed to be pretty good. And I like the idea that they're now getting into emulators. They're re-releasing the Nintendo Entertainment System. I know guys of my age will be buying that. I plan on getting one. It's only like $60 or something with 30 amazing games, all the Marios, the Zeldas, so on and so forth. It seems to me like Nintendo realized that they were a fledgling brand. I actually am very frustrated by this move because I had been planning on talking about Nintendo as creating a base and as a takeout target for like an Apple or someone for gaming. And then this Pokemon thing came and basically got the move I was looking for. Very, very, very frustrating. I had been talking about this with some friends of mine, and it kind of just took off. 200-day moving average, that's why I was saying I'd be looking to kind of initially buy a small here and then buy here, just because it's hard to reference a parabolic move like this. but that's part of the plan from the beginning. When it's not okay to add to, let's say, a losing trade would be is if you aren't planning that kind of from the beginning and don't have technical basis. This is sort of what you do when you're looking to kind of fish for a bottom. Another one I'm starting to like is this CSX. I actually am long a little bit of this. I like that you had a downtrend break with the earnings, and I like that you have a failed head and shoulders and potentially a longer term inverse head and shoulders here, and you have the kind of the neckline break. It's filling in, it's holding above that area. Well, I like it as, I like it as long as it holds above this break. If that fails, then it could fall down to the 50 or the 61.8. I think that this area would hold. It's within, I guess, a point or so of this reference level, so I'm kind of okay with this as long as it holds the 26.92. Anything below there to me gets really iffy. It really shouldn't be back down there, though, because this is the earnings breakout bar. To get back down to that low of it is stretching it a little, is really stretching it a lot. I mean, you'd be losing most of this rally. So right now I'm just using this 27.97. Anything back below there and this pullback low, I'll probably not be so long. I'll probably use it as a stop. That's CSX. By the way, UNP reported on Friday, and they were it was initially a gap down, and then it rallied and closed near the high of the day. So I like how the sector is performing. Just I think that this has to do with coal. Coal looks like it's turning the corner and bottoming. So as rail loads come back up, maybe that's signaling a Trump presidency, and coal will come back. You know, he always talks about he likes coal. I think that could be great for the rails. Starbucks. So Starbucks had pretty good price action. They had a little bit of sell the news initially. It had been down, and now it's back up. The 200 had been a lot of support. It might be some resistance here. This could float up to the channel high and fill this gap. But I think that this might set up for more of a short, and I'll tell you why. If you look at Joe or Cafe, I mean, look at this. This, to me, is looking like it's forming a rounded bottom in coffee prices. And coffee, obviously, they got a benefit from the move down here. But if this really is bottoming and this is going to rise, that, I know Starbucks hedges a few years out, but I can't see this being good for them. It's sort of like oil falling, not being good for oil companies. Coffee prices rising for a company that uses it as their main input. It can't be a good situation. You can see Cafe is kind of forming the same kind of rounded bottom. So my thoughts on Starbucks is that the price action was okay on the earnings. The stock still looks like it might want some higher. You can use this range, the earnings gap RTH range, the 57.20. Anything below there to me would be more suspect. Above the high, you probably see the 200 and maybe the channel high to the gap fill. But I would start booking some profits in this, I just my theory. I mean, this isn't really overly bearish. It's really just more of a sideways consolidation pattern, not a very steep channel. They might want to retest the old all-time high or whatever, which was a 1.618, basically just shy of a fib extension. I'm having a hard time getting behind this with coffee prices rising. So Starbucks, I think we take, if you're in it, you want to be looking to take some profits. I'm not. I have no position in the stock at the moment. PayPal. All right, so I think we traded this pretty well. I talked about buying this on the professional gap. I don't know why I deleted this, but I did. The downtrend break here. Let's see. You could draw it a couple of different ways. We'll just do it this way for now. The other way is really the better way, but you had a gap and go above a downtrend. You rallied into some reference resistance. This was initially a gap higher up into like almost the channel high in non-trading hours. It was like I saw it in the 43s. So I talked about booking some profits and using 41 as a stop. That turned out to be quite prescient. This wound up being down a lot. They did a deal with Visa. The deal sounded okay to me, but a few houses didn't like it. So you basically gap down to the gap fill and to the tick. Look at this. Low of day was 36.43, was the 61.8 of the range. I liked it as a buy. I talked about it at the time, and it wound up closing pretty high. I would add to the position over the high of day. and just use the below the low of day as a stop out. And if that happened, you'd probably see the channel low. I think that this stock eventually wants higher. I think that this, believe it or not, could be a takeout target. They were once in the past. This was the resistance or the old support in the 37.68-ish area. Could even extend that down to 37.31. The high a day here was 37.59. So this, I guess, area of buyers is going to be some resistance for a little while, but I like PayPal. I think if you don't mind owning it here, you can sell some at the money puts and just start building a bit of a position. That's my thinking. So this earnings gap range here is the key. Anything below the low, a little bit iffy, could come back and retest the backside of the old downtrend line, and maybe the reference, other reference lows. But as long as this holds, I think that it could maybe want to fill in that gap again. Anyway, that's my story. I'm sticking to it. We covered a lot of material in under an hour. I'm very impressed with myself. Anyhow, if you're not following me on Twitter, my handle is @JustinPulitzer. If you like this video, hit the thumbs up button in the lower right-hand corner below the viewing area. And please leave me some comments. It's your comments that help me make the videos better. Anyway, that's my story. I'm sticking to it. Have a great rest of your weekend, and cheers.